Good morning, children. Welcome to the part 7 of the chapter Cash Flow Statement. In the previous videos, we have done how to calculate cash flow from operating and investing activities, and in this we are going to study how to calculate cash flow from financing activities. So the format which is given here is the format of financing activity, the C point. Cash flows from financing activities. In this, we are going to add all the cash inflows pertaining to the finances of the company or the business organization, and we are going to deduct all the cash outflow pertaining to the finances of the organization. So as you can see, proceeds from issue of shares and debentures. If the company has issued its own shares and debentures to some other companies or investors, then in that case, in place of or in exchange of shares and debentures, money will be invested or the cash will be coming in the company, and therefore it will be a cash inflow. So it will be added under financing activities. Then second one is proceeds from other long-term borrowings. In the similar manner, if the company has taken any long-term loan from the business, from any other bank or any institution, so by taking that loan also the money will be coming in. There will be a cash inflow. So that will also be added under the cash flows from financing activities. Then proceeds from short-term borrowings. If there is an increase in the balance of bank overdraft or cash credit. We have already discussed that according to the new rules as per ISC Council, the bank overdraft and cash credit are treated as short-term borrowings under the financing activity. So if there is an increase in the value or balance of bank overdraft or cash credit, it implies that the company has taken more of short-term loan from the bank. So that increase will be shown as a cash inflow. It will be added under financing activities. On the contrary, if there is a decrease in the balance of bank overdraft or cash credit, so this will imply that the amount of bank overdraft or cash credit has been repaid, and that's why it has a decrease. So therefore that amount will be shown as a cash outflow and it will be deducted under financing activity. Then after that, any interim dividend paid or any proposed dividend which was proposed in the previous year, because it was proposed in the previous year, it must have been paid in the current year. So any interim dividend paid during the year or any proposed dividend of the previous year, any interest paid on short term or the long term borrowings, any interest paid on bank overdraft or cash credit, so all these payment of dividends and interest will also be shown as a cash outflow because the company is paying it under the financing activity. Then later on, any repayment of loan, whether it is short term or long term, if the loan is repaid by the company, again the cash is going out, there is a cash outflow and it will also be deducted under the financing activity. And the last one is redemption of debentures. So when the debentures are redeemed, repaid, the money is paid back to the debenture holders, then that will also be a cash outflow. It will also be deducted under financing activities. So after adding all the cash inflows and deducting all the cash outflows from financing activity, in the end we will be getting net cash from, if it is a positive balance, or used in if it is a negative balance, financing activity. So this was the format for financing activities only, and we know that we have already studied the full-fledged format of the cash flow statement, and now what we are doing is we are studying it in different parts, because sometimes the question asks you to prepare only the operating activities or only the investing activities or the financing activities. So therefore we are doing or discussing it separately and doing the questions thereon, and thereafter we will do the full-fledged types of question on the entire cash flow statement. Now there are certain important points to be noted, especially regarding the financing activities. The first point being, proposed dividend for previous year is declared or approved in the current year, and hence it will be added back to the net profit to determine the net profit before tax under operating activities. It will also be shown under financing activities as an outflow of cash. This point we have already discussed beforehand, that according to the new ISC rules, the proposed dividend or the dividend which is proposed by the company is approved in the annual general meeting AGM, which is held only and only after the end of the financial period or the accounting year. So therefore, the proposed dividend which has been proposed in the current year, it will be approved in the next year. So therefore, the proposed dividend of the current year will not be shown anywhere, rather it will just be shown as a contingent liability. It will not be a part of the balance sheet or the cash flow statement. But the dividend which is proposed in the previous year must have been approved in the current year, and therefore, since it is a financing nature item, therefore it will be added back to the profit while calculating net profit before tax, as we have already discussed. And in the second place, it will be deducted as a cash outflow under the financing activities. The second point is, just I have explained you in the first point itself, that proposed dividend for current year will be declared or approved in the next financial year. Hence, it will have no effect on cash flow statement. While preparing the balance sheet, it will only be shown as a contingent liability. The third point, dividend on preference shares is paid before payment of dividend on equity shares. That we know, because preference share gets a preference over the equity shares. So therefore, whenever the dividend is paid, dividend is primarily paid to the preference shareholders, and then after that it is paid to the equity shareholders. So if any question specifies that the company has paid interim dividend on equity shares, and if the question is already having the preference shares, so that is quite obvious that if it is paying interim dividend to the equity shares, that means it must have already paid the dividend on the preference shares also. So in that case, this is kind of an implied dividend which you need to calculate and deduct. Then point number 4, bonus shares are issued to existing equity shareholders without charging any amount from them. Bonus shares are basically given to the existing shareholders free of cost. So hence, there is no cash inflow on issue of such bonus shares. So hence, bonus shares given in the questions are not shown in the cash flow statement because there is no flow of cash. Then the fifth point, interest paid on long-term borrowings is added back to the net profit before tax because it is an expense relating to financing activity, and also because it is a non-operating expense. It is shown as an outflow of cash under financing activities. Now let us discuss a question over this. This is practical question number 29, and as already explained you in the previous videos, that there might be a change in the date depending on the edition of the book you are having. So the question says, calculate cash flows from financing activities from the following information or particulars. The two balances of two consecutive years is given to you. First is 31st March 2018 and the second one is 31st March 2017. So it implies that the balances as on 31st March 2018 is the current year balances, and that of 2017 is the last year or previous year balances. So the particular says that there was equity share capital of worth rupees 7 lakh in the last year, and it has increased to 12 lakh in the current year. So this 5 lakh of increase may be because of further issue of share capital, and any issue of share capital will be shown as a cash inflow under financing activity. So immediately we will not do this. We will first of all read the additional information also. Then second particular, 8% preference share capital, last year it was 1 lakh and current year it is nil. So that means this preference share of 1 lakh, preference share capital of 1 lakh must have been redeemed, repaid back, and therefore it is showing nil balance. So it will be a cash outflow. Again, before writing it off, we'll go through the additional information also. The third particular is 9% debentures. Now again, these percentages which are prefixed to the preference share capital or debentures, these imply the rate of interest or dividend on that particular share and debentures. So 9% debentures, last year there was no 9% debentures, but in the current year there is 9% debentures of 2 lakh rupees. So again we'll be going through the additional information also, but anyhow this 2 lakh is due to issue of fresh debentures. Then 7% debentures, last year it was 1 lakh, this year it is nil, that means it has been redeemed or repaid. One more very important point for you to remember, children, that we'll be discussing when we discuss the shares and debentures chapter also, that whatever amount is shown in the equity share capital or preference share capital or debentures, they show the face value. That means the value which is printed on that particular shares or debentures. Now the additional information. Point number 1, equity shares were issued at a premium of 2%. Now the value which is shown in equity share capital, last year 7 lakh and current year 12 lakh, that is the face value. That means the shares, equity shares of 5 lakh face values has been issued, but additional information says it has been issued at a premium of 2%. Premium means above 2%. So that means 5 lakhs shares has been issued at plus 2%. So 2% of 5 lakh will be 10,000. So that means the shares of 5 lakh has been issued for 5 lakh 10,000. Then the second point says 8% preference shares were redeemed at a premium of 2%. Now last year the preference shares are 1 lakh, current year nil. That means the entire face value of 1 lakh of preference shares has been redeemed or repaid. But the additional information says it has been redeemed at 2% premium. That means 2% more. So 2% of 1 lakh will be 2,000. So that means preference shares has been redeemed at 1 lakh plus 2,000, that is 1 lakh 2,000. So it is being paid, that means it is a cash outflow and it will be deducted under the financing activities. The third point, 9% debentures were issued at a discount of 1% and 7% debentures were redeemed at a premium of 5%. So there are two categories of debentures, one is of 9% and one is of 7%. So the question says that 9% debentures were issued at a discount of 1%. As we can see, last year there was no 9% debentures, but current year the face value of 2 lakh rupees 9% debentures has been increased. That means it is an issue. And the additional information says that it is issued at a discount of 1%. So 1% of 2 lakh will be 2,000. So it is issued at a discount, that means 2,000 less. So 2 lakh minus 2,000, that means debentures have been issued for the amount of 1,98,000. So this is a cash inflow and it will be added under the financing activities. Then the second part of this point says 7% debentures were redeemed at a premium of 5%. So that means the 1 lakh face value of debentures which is being repaid or redeemed in the current year is redeemed at a premium of 5%, means 5% more. So 5% of 1 lakh will be 5,000 and 1 lakh is the face value. So that means debentures has been redeemed at 1 lakh 5,000. So this is a cash outflow. It will be deducted under the financing activities. The next point. Underwriting commission on equity shares was paid at 2.5% on the issue price. Now, we are paying the underwriting commission to the underwriters for issuing the equity shares at the rate 2.5% on issue price. Now, very important. What is the issue price? The equity shares are issued at a premium of 2%. So, 5 lakh is the face value of the equity shares issued plus 2% of the premium. That means the share issue value is 5 lakh 10,000. And we are also paying 2.5% of underwriting commission, which can be deducted from this itself. So 2.5% when we calculate on the issue price, that is 2.5% of 5 lakh 10,000, it will come to 12,750. So it will also be deducted from the proceeds from issue of equity share capital, and ultimately the net amount received from issue of share capital will be 4,97,250. So this will be a cash inflow which will be added under the financing activities. Then the next point, interest paid on 7% debentures is 7,000. So interest paid on debentures, it is a cash outflow. It will be deducted under the financing activities. Then next, the last point, dividend paid on preference shares is rupees 8,000. Again, dividend is being paid on preference shares. It is a cash outflow under the financing activity. So it will be written like that. Now, since there is the dividend to be paid on preference shares is already given in the question. The interest paid on 7% debentures is also given in the question. So we need not recalculate it. We can just use the value therein. So that means there is no case of implied interest here. And there is no case of implied dividend also. But the question of 9% debentures which were issued, since again just repeating the points which we have discussed in the previous videos and previous questions, that since the date is not mentioned when was the debentures issued, 9% debentures were issued, so therefore we will assume that these were issued basically on the last day of the current year, that is 31st March 2018, and therefore no interest is calculated on 9% debenture. So this is the question which I have already explained you. Now let us quickly go through the solution. As you can see, we are showing cash flows from financing activities because in this question you are required to prepare that. So first of all, we have shown the proceeds from issue of equity share capital. How we have calculated, 5 lakh is the issue or the face value of issued shares, plus because these are issued at 2% premium, so 2% of 5 lakh will be premium of 10,000. And we have also, now the issue price becomes 5 lakh 10,000, on which 2.5% is to be paid as the underwriting commission. So 2.5% of 5 lakh 10,000 will be 12,750. We have adjusted the underwriting commission from here itself because it was paid for issue of equity shares only. So ultimately the proceeds from equity share capital is coming to 4,97,250. Then their preference shares were redeemed. They were redeemed again at a premium of 2%. So 1 lakh was the face value of the preference shares redeemed plus 2%, that is 2,000. So ultimately the preference shares were redeemed at a value of 1,02,000. Now, since the preference shares are being redeemed, that means there is a cash outflow, and that is why it is being deducted under the financing activity. The third point is the proceeds from issue of 9% debentures. Since the 9% debentures were issued in the current year, the face value was 2 lakh, but these were issued at a discount of 1%. So 1% of 2 lakh will be 2,000. Therefore, the issue of debentures has given the amount of 1,98,000. This is a cash inflow, therefore it is being added. The next one is redemption of 7% debentures. The face value debentures of 1 lakh has been redeemed at a premium of 5%. So that means it has been paid or repaid at 1 lakh plus 5% of 5,000. That means 1,05,000 is being paid, and since the debentures are being redeemed or repaid, it is a cash outflow, and therefore it is deducted under the cash flow from financing activity. Then interest paid on debentures and dividend paid on preference shares is also a cash outflow, and therefore these are also deducted under the cash flow from financing activity. Now, after adding all the cash inflows and deducting all the cash outflows, we are getting a positive balance of 4,73,250, which is net cash flow. Since it is a positive balance, that's why we are writing from financing activities. If it was negative, then we would have written used in financing activities. So this is the solution for this question, children. Now the note that which I have already explained you, underwriting commission will be 2.5% on issue price, and issue price is the face value 5 lakh plus the premium of 2%, that is 10,000, that means 5 lakh 10,000. So I hope this question is clear to you, children. Let us discuss one more question. Question number 32. Again, it might be the serial number or the date might be changed. So the question says, Sony Limited provides you the following information. Calculate cash flows from the financing activity. The 2-year consecutive balances is being given to you. 31st March 2018, the current year, and 31st March 2017, the last year. So the first particular is the equity share capital. Current year it is 12,50,000 and last year it was 10 lakh. So that means there is an increase of 2,50,000. This might be because of issue of share capital. The second one is 8% preference shares capital. Last year there was no preference share capital, and current year there is a preference share capital of 2 lakh. So it might be because of issue of further preference shares. Then 10% debentures. Last year it was 3 lakh, current year none, or nil balance is there. That means this 3 lakh debentures has been redeemed. And the last one is investment in shares. Last year 1 lakh and current year 1,50,000. That means we are investing in shares of some other company. So it is not a part of financing activity. It will be shown under the investing activities as 50,000 increase in the investment. Well, anyways, we don't have to prepare here. We just have to prepare the financing activities. Additional information. Point number 1. During the year 2017-18, that is the current year, Sony Limited issued bonus shares in the ratio of 4:1 by capitalizing the reserve. So that means the increase which is there in the equity share capital, that is due to the issue of bonus shares. And we had discussed the note that whenever the bonus shares are issued, they are issued free of cost. There is no cash inflow regarding that. So therefore this will not be this increase in equity shares due to issue of bonus shares will not be a part of the financing activity or cash flow statement, since it is a non-cash item. The second point, 10% debentures were redeemed on 1st January 2018 at a premium of 5%. So the face value of the debentures which were redeemed is 3 lakh, and these are redeemed at a premium of 5%, that means plus 5%. So 5% of 3 lakh will be 15,000. That means these debentures are redeemed for 3 lakh plus 15,000, that is 3,15,000. And 3,15,000 will be the cash outflow. It will be deducted under the financing activity. And since the date is specifically mentioned here, that it is being repaid on 1st January 2018, and our accounting here has started from 1st April 2017, and the rate of interest is also given. So this is a case of implied interest, since no other information is also not given. So we will calculate the 10% of interest on debentures from 1st April 2017 till the date of redemption, that is 1st January 2018. That comes to 9 months. So 10% interest on the face value 3 lakh for 9 months. We will calculate the interest which will be paid on the debentures, and it will come to 22,500. And since we are paying the interest on debentures, it is an outflow of cash, and it will be deducted under the financing activities. The last one is the second last point. The third point is preference dividend paid. Now dividend paid, again it is a cash outflow, and it will be deducted under financing activity. And the last point, dividend received on investment. Now since it is the dividend received, that means it is you can say you have invested somewhere, or the company has invested somewhere and is receiving the dividend. So it is a part of investing activity. It is a cash inflow under investing activity, and it will not be a part of the financing activity. Now let us quickly look at the solution. The first point, cash flows from financing activities. The first point is showing the issue of 8% preference share capital, that is 2 lakh. Then preference dividend paid, already given in the question, it is an outflow, therefore we have deducted 800. And preference share capital, when these are issued, the cash is coming in, there is a cash inflow, therefore 2 lakh has been added, and 8,000 is dividend paid on preference shares, and that's why it is a cash outflow, and therefore it is being deducted. The third point is redemption of 10% debentures. That means 10% debentures are being repaid. So it is a cash outflow, and therefore it is being deducted under the financing activity. And how much we are repaying? We are repaying the face value 3 lakh plus the premium over this of 5%, that is 15,000. So in totality we are repaying 3,15,000. Then the next one, that interest paid on debentures. Again, how we have calculated, the rate was given 10% debentures. It has not specifically given, but it is implied. So 10% debentures, the 10% interest is being calculated on debentures, the face value 3 lakh for 9 months, which is coming to 22,500. And again, since it is the interest paid on debentures, so it is a cash outflow, and therefore it is being deducted. So after adding all the cash inflows and deducting all the cash outflows, the net cash which is being calculated is 1,45,500 negative. So therefore we have put the balance in bracket, and also we have used the word used in. That means this balance, negative balance of 1,45,500, is showing the net cash used in financing activity. So I hope the question is clear to you, children. Now the working note. Point number 1, there will be no cash flow due to issue of bonus shares. Why? Because these are issued free of cost. Then the second point, investment in shares and dividend received or investment will not be recorded in cash flow from financing activities, because these are the part of investing activities. So these were the two questions. I hope the questions discussed in this video are clear to you, children. Now this is the assignment. Based on this part, you have to answer the following questions in your register. You have to solve practical question number 31 and 34 from the chapter Cash Flow Statement of your accounts book by D.K. Goel, volume 2. Thank you, children. Take care.